Good afternoon and welcome to the Florence School of Banking and Finance. My name is Pierre Schlosser and it is my pleasure today to host this online seminar called Lost in TLAC with Tobias Tröger. Tobias, a warm welcome to you. If it is the first time that you join us, I can picture a very big question mark on your face right now as regards this platform and all. So let me say some introductory words about who we are and what we do. So Florence School of Banking and Finance is part of the European University Institute located in Florence. As was recalled, the institute was set up around 40 years ago and over the years became the unique place that it is today, namely a leading international research institute in economics, law, political science, and history, while still being an intergovernmental institution. Our School of Banking and Finance is one of the Institute's many programs. It is also one of the most recent ones because its creation dates back to January 2016. The school can best be defined as a European platform that brings together practitioners and academics from the banking and finance sector. They all share the objective of enhancing Europe's financial stability. Alongside its policy dialogue initiatives, the school hence offers various executive training courses combining residential and interactive online formats. Our long-term goal, which is quite ambitious, is to shape the emergence of a common regulatory and supervisory culture in Europe. In its first year of activity, the school has trained more than 500 experts, as you can see on the slide, coming from more than 30 European countries. As you can see, especially on the donor chart, our training participants were mostly active in central banks, but also in European institutions and academia. Moreover, the school also hosts policy dialogue activities. You will see the gist of our upcoming events until the summer on the slide, and I look forward to meeting you in Florence in one of those occasions. So that's all for the school. Let us now move over to you. You are more than 163 right now with us today. It is terrific that so many of you have taken the time away from colleagues and friends to spend it with us and TLAC. So where do you come from? If you look at our summary map, you can see that it captures your geographical origins. You can observe that you come from 28 different European countries, plus the US, plus China, and South Africa, I'm happy to say. In terms of organization, we're very happy to count on numerous participants from our institutional partners, the Single Resolution Board, the European Central Bank, and many other European and national institutions. This incredible diversity is also illustrated by our word cloud, which features some of your first names, so don't be surprised. Let me say again that I'm very grateful that you are participating in this online seminar. We will rely a lot on you today to make our conversation as interactive as the technology allows us to be. As you will notice, our platform features a box where we will have our live Q&A session after Tobias' presentation. It will, however, remain active during the presentation for clarification questions. So the general setup also includes a box that will appear when we'll conduct our interviews, our interactive polls on the bottom left corner. There will be several of them in today's seminar. So this being said, I'm very glad to introduce now to you Tobias Tröger from Goethe-Universität in Frankfurt. I'll ask Tobias to join us. Tobias is the guy who will shed light on the topic of today and make sure that we will all be smarter in an hour from now. So Professor Tröger, thank you for that. Tobias holds the chair of private law, trade and business law jurisprudence at Goethe-Universität in Frankfurt am Main. He is also program director corporate finance at SAFE, also in Frankfurt, and chairman of the board of the European Banking Institute. Tobias, I don't have to remind you that this is not an ordinary Skype call and that there are more than 173 other persons on the line, right? So with no further ado, I will now leave you in Tobias' company and we'll tune back in for the Q&A. Thank you.
I'm very glad to be here today, and I hope that the technicalities work out as nicely as they did during our preparation sessions. And without much ado, I will immediately start with the substance of the talk. And the catchy title already hints at something that can be framed as a translation problem, which is not uncommon and is not only pertinent in banking regulation, but particularly there where the policy objectives that are drawn up are not easily transformed into operable regulation that is law. And this is due to a couple of reasons. One is simply the legislative process, which, as you all know, actually requires that political decision makers make compromises among many constituents, and this leads to a relatively detailed and complex set of regulation that still stem from a very, very simple concept of banking policy. And another aspect that those of you who are now at the moment trying to get a hold on these new regulations and trying to implement them in practice, of course, is also that regulators try to solve certain trade-offs that are inherent in the banking policy that is implemented through regulation. And of course, regulation always wants to achieve something, but it wants to avoid undesirable lasting consequences, and that is why it is typically a set of rules with an exception to the exception, which adds to the complexity. And this is particularly true if we're looking at the regulation that is commonly known as TLAC, or its close European relative, MREL, because there we also understand that there is probably an underlying very basic concept here that somehow gets lost in the translation into operable law. And the guiding questions for today's presentation that I want to make sure are actually present while we are going through the materials is how much of the basic concept that underlies bail-in, because as we will see in a minute, TLAC and bail-in are intricately intertwined intertwined with the concept of bail-in, and how much of this basic concept actually gets lost in the implementation process, and even more important, particularly for those of you who are actually in the enforcement, in the implementation of these regulatory prescriptions, how much can be recovered if we approach the interpretation of these standards in an informed normative way that actually takes into account the basic policy objectives that are underlying it. So the roadmap for today's talk, I want to just briefly remind you about the interconnection that I already hinted at between the bail-in tool, TLAC, and MREL. And after that, as a starter, I will give a closer look to certain key TLAC and MREL prescriptions that are, I think, where a couple of insights can be gained from relating them to the basic concept of bail-in. So one aspect is the simple question of how you actually calculate MREL and TLAC. The second is, what about eligible liabilities? So is in the regulation of eligible liabilities something that we can actually learn how this whole thing is supposed to function and how we can improve the situation here? And then, of course, another aspect how banking groups are actually treated. Because that's one of the critical issues, of course, in cross-border failures of banks, how you actually treat a cross-border banking group. And then another aspect that I think is highly topical with the current events going on in Italy, what about the restrictions on holdings? Are they relevant? Are they adequately addressed in the regulation? And on this basis, I will conclude, and then we can have a Q&A on what you understood today. So one thing, the first question that occurs is, what is the objective of the regulation of TLAC and MREL? So it's there, so we have to implement it, but what's the objective? And the Financial Stability Board that is in charge with regard to TLAC has put it this way. They're saying the objective of this standard is to ensure that G-SIBs have the loss absorbing and recapitalization capacity necessary to help ensure that critical functions can be continued without taxpayers' funds, public funds, or financial stability being put at risk. So essentially that means, we want to have financial stability. We want to make sure that we can recapitalize failing banks. And to put it more clearly, the FSB also has made it clear that there is this connection between bail-in and TLAC, because they are simply saying the goal is to have sufficient capital available for bail-in by prescribing TLAC. So this is the minimum that is required in order to make this instrument work. And of course, in this regard, MREL is pretty much the same thing, because the European Commission has also put it, or the European legislator has also put it like the FSB did. So it's about making bail-in work. And of course, in this regard, our first poll is a little bit of a self-explaining. So is MREL TLAC helping making the bail-in work? Well, it looks like it should, but we will see there are some problems in that. Now, it all boils down to the question, what is the rationale for bail-in? What is the rationale why we actually want to have private sector involvement in recapitalizing a bank? Now, it's a guiding principle after the crisis of 2007 and 8, as you all know, that we want to achieve two things. We want to preserve public finances exposed, so once the crisis hits, we don't want to spend public funds. And this should, ex ante, bolster market discipline. So private sector loss participation as the panacea to pretty much all the problems that we saw during the crisis. And of course, we all want to achieve this without imperiling financial stability, which is the paramount goal here. I think all these objectives are pretty much understandable, but we have to look a little bit about at the workings of how we actually can foster market discipline through bail-in, because this is a key question, and this is something that will be the benchmark for our assessment of TLAC and MREL, whether they can actually contribute to achieving this goal. Now, to make that clear, if you look at this very simplified balance sheet of a bank, you understand there are liabilities, there are assets, and of course, the decisions that are taken on the asset side clearly depend on how much funds are available. And the size and the composition of the liability side of the balance sheet clearly depends on market pricing. So how expensive simply it is to raise funds. And the availability of funds drive investment decisions, risk-taking decisions, and in that sense, you have the transmission channel through which you get either market discipline because the prices are giving a sensitive information about the risk that is inherent in the bank, or you get market failure, that is, if these pricing on the liability side, if the pricing of bank debt and equities is risk insensitive. And if the assessment, and that was the assessment of the policymakers after the financial crisis, is that the latter occurs, that there is a market failure, then this is a legitimate cause of regulatory intervention where you simply ensure through regulatory measures that private sector loss participation occurs, that government guarantees are undone, and risk and funding of banks gets risk sensitive again. Now, if that's the case, then it is important that bail-in actually works. And how can TLAC and MREL actually help making bail-in work? And that's going to be our benchmark. And to understand that, we have to understand how the bail-in tool actually should look like from a policy perspective in order to work properly. And this is all well known, but just to remind you, the key aspect to get market discipline is that investors understand what their potential loss can be if the bank actually fails. So you have to have an ex-ante designation of bail-inable debt. So it should be a clear-cut trigger event. You have to know which instruments are actually subject to bail-in, and the specific consequences should be predictable. And on the other hand, of course, if you recall our financial stability goal, it is important that the bail-in, if it occurs, does not destabilize markets so that you do not get knock-on effects. So the holders of bail-in debt should certainly have credible loss-bearing capacity, and who this could be is a question. Now, what can TLAC and MREL, so the prescription of a minimum holding or a minimum issue of bail-inable capital actually contribute? Well, clearly it can contribute if it becomes more evident which instruments are actually subject to bail-in, and it can also contribute by saying, okay, I restrict through either directly or indirect measures the holding of non-suitable investors of these bail-in capital. And if you look at this, we have now a very clear-cut benchmark through which we can evaluate the actual regulation. That's what we're going to do in the second part of the seminar. And first issue is the calculation of TLAC and MREL for that purpose. So don't worry too much about the legal basis for all this. So essentially, the one is coming out of the FSB, which is only soft law, but de facto is, of course, some regulation that becomes binding through the implementation through national legislators. And on the other hand, we have the BRRD, or the Single Resolution Mechanism regulation, but that doesn't matter that much. The key issue that I want to highlight here is that whether you calculate TLAC through a risk-weighted asset minimum or through the leverage ratio exposure minimum, it really doesn't matter. It's a fixed ratio, and that is important. That it typically TLAC is something that is designated as a minimum for all the institutions, for all the GSIPs that fall under the application of this FSB standard. Whereas MREL is less clear in this regard because it's a figure that is calculated on an individual basis for each institution that is coming under the BRRD. But another important aspect that I want to highlight is, of course, if you prescribe capital that is available for bail-in, you're doing something that, of course, has to be aligned with the general capital requirements that occur, because bail-in also includes Tier 1 and Tier 2 instruments. That is, TLAC and MREL also include these instruments, and then you have to determine the interrelation. And here's something that, of course, adds complexity once again, and we have to be sure what we want to achieve in order to make this as clear as possible. So there's a coordination issue here, which in the European ambit is particularly pronounced because capital requirements are administered by the supervisor, whereas MREL is determined by the resolution authority. So there's a need for interagency cooperation, which of course makes the predictability of outcomes a little bit less stringent than it could be. Another aspect, and I don't want to march you through the details here, is of course which liabilities are eligible. The regulation in this regard is mostly a question of framing, because you can either say I exclude certain liabilities if they have the following properties, or you can say I think the following liabilities are eligible if they do not have the following properties. So by and large, both the European and the global standard are aligned. I just want to highlight one aspect which I think is critical. We all know that there are certain exceptions from bail-in. So despite the fact that it is in principle a bailable instrument, the institutions, the resolution authorities can actually make an exception from bail-in. And if they do, as you all know, the question, of course, becomes how predictable is this decision? And the TLAC standard helps in this regard a little bit by saying, okay, we make sure that the loss absorbing capacity that's inherent in the bank is by no means dependent on these decisions, because we more or less radically exclude all these liabilities that are subject to a discretionary bail-in exception. Whereas in the BRRD, it is a little bit less clear, because here it is still possible to include these liabilities that potentially are exempt from bail-in if the latter, so the exemption, is not predetermined in the resolution plan, which means that it can still occur in the resolution situation, but it hasn't been foreseen in that regard. But the important aspect here is that despite the fact that MREL should make it clear which liabilities are actually subject to bail-in, it is not clear, because here's a discretionary element which actually can overthrow all the pre-calculations that you have made as an investor ex ante when investing in this debt instruments. Another aspect that is, of course, adding complexity, particularly in a cross-border context, is that the loss-bearing capacity, of course, hinges on the fact that these TLAC instruments should be subordinated to any instruments that are ineligible for bail-in. So they have to absorb the losses prior to these ineligible instruments. And there are three solutions, as those of you who are struggling with implementing the standards actually know. What can either go through contracts by inserting a clause in the bond saying, well, this bond is subordinate to anything that is excluded from bail-in. But that, of course, requires, in a cross-border context, that resolution authorities who might actually apply the bail-in clause recognize the subordination clause. And this, of course, gives rise to a lot of litigation issues. The same is, to a lesser degree, but still true, if you do it through a statutory subordination. So if you have a kind enough legislator who, in its insolvency laws, actually says this is subordinate or not, the question here is, of course, how do you ensure that actually all the resolution authorities involved and all the courts that are after the fact checking these decisions are recognizing the ranking that is laid down in insolvency laws. And that is even true if you go through corporate law, so structural subordination. You have all the bail-inable instruments, all the TLAC instruments issued through an institution that doesn't hold any excluded liabilities, but still then there is some insecurity coming from the fact that foreign courts, foreign authorities might not accept this corporate structure if it is in fact only designed in order to make certain liabilities junior to the bail-inable ones. Now, the question immediately translates into the idea how TLAC and Amaral can actually help ensure that we are confident that also cross-border groups can be resolved in a cost-effective way. Now, the problem that we all know, and those of you who have followed the events after the financial crisis know pretty well, that in theory, it's a great thing to have a banking group because loss sharing can occur, capital support can be given among the group members. But in fact, there's also an aspect that is quite important and makes the idea of having intra-group support a little bit, allows us to look at it a little bit more realistic. The preferences of resolution authorities, assuming that they serve the constituents in their home country, differ dramatically in the situation of a bank resolution, because the costs and the benefits that the respective economy incur differ dramatically. And in this regard, of course, if that is what's driving their decision making, we might actually see certain breakdown of cooperation across national borders. The question, of course, here is how can TLAC and Amaral actually contribute to that? Well, the TLAC standard in that sense is pretty realistic, I would say, because it says, well, in general, we calculate TLAC only with regard to the resolution entity that is the part of the banking group where resolution tools are actually applied. So that means we're only looking at the institution that actually will be the one that is reorganized or resolved if the failure occurs. But we also acknowledge that certain national authorities might not go along with this decision and might not be confident enough to rely on this mechanism where we have one point of entry. But this is why we actually require that some internal TLAC is pre-positioned within the banking group if we have a material subgroup that is important for a certain economy. So for the foreign operations have a significant size. And now the EU regulation actually goes one step further by saying, well, in general, we calculate Amaral only for individual institutions. So both parent and sub are subject to these requirements. So they all have to hold sufficient bail-inable capital. And there is only a minor exemption which allows us to make some discretionary exemptions if we understand that there is a material subgroup that still is where the likelihood that it is supported by the center is actually pretty high. And the realistic assumption here is this is probably something that we will only see if the subgroup resides in one member state only. So there is a big difference at the moment between these two standards. The EBA still says that the concept of external and internal TLAC is also possible to be implemented under the European regulation, but the fact that you have to have sufficient bail-in capital in each and every institution makes that significantly more difficult and costly. And the final point that I want to make with regard to TLAC is, of course, how do we ensure that consistent behavior of political decision makers actually occurs if there is a situation where the holders of bail-in capital do not have, for whatever reason, do not have the loss-bearing capacity to actually take the hit of a bail-in. Then, of course, there in another form, the rationale for actually bailing out banks might reoccur. And we have two problems in this regard. One is banks. So if actually most of the bail-in capital is held by other banks, we might see the problem that there is, of course, knock-on effects if you write down or convert these instruments, because this immediately hits the asset side of the balance sheet of these institutions. Now, the TLAC standard, I think, takes pretty good care of this problem because it says, well, if you, for whatever reason, choose to hold bail-inable capital that comes under the TLAC standard, then this has to be deducted from your own TLAC from fulfilling your own TLAC requirements. But the big problem, and that translates into what we see at the moment in the European context, there is nothing that addresses the problem. What actually happens if retail investors invest a good sum of their estate into these instruments and then all of a sudden become subject to bail-in and lose their fortune or lose the basis for their living, retirement savings, and stuff like that? There is no treatment of that. And the same is true with regards to the European regulation, where the situation with regard to banks is even a little bit more problematic, because there is not much that resolution authorities can actually do to address the problem if they find tremendous, if you actually find too many banks holding too much bail-in capital of other banks. And clearly there is nothing that addresses the problem of retail investors investing in these bail-inable instruments. Now, what is the takeaway from this? Well, in this regard, I would say that Tilak and Amaral are just having common problems that need to be addressed for further regulation. But I think the topic is on the agenda at the moment, and everybody understands where the problems actually lie, though there's only one question, that how we want to address this. But another aspect that I just want to now highlight in my conclusion is, well, bail-in under the BRRD is complicated. That is something that a practitioner from the city, Simon Gleason, has concluded, and this will remain so despite the fact that we now have MREL standards, that we have TLAC in place, but this doesn't only do so much. There are some uncertainties and ambiguities that remain, and these stem largely from the fact that the implementation of these very complex rules and standards requires essentially those working in these institutions that are now implementing these standards, that requires you to make certain choices. And in this regard, it is clear that TLAC and Amaral do something because they make private sector involvement a little bit more predictable, but there's still a lot of ambiguity in that. And that means that the implementation of these standards should be stringent and impartial and based on firm principles. And for that purpose, I think it is important to keep in mind what you actually want to achieve through these standards. And that is, now concluding the talk, actually ensure that private sector involvement is predictable ex ante at the time of investment. And to give you something on your way, that automatically means be as transparent and as time consistent as possible in your decisions and make that clear to the markets. And I think that's my main posit that I want to give you on your way. And of course, I wish you good luck and thank you for your attention.
compelling and rich presentation. So I personally have learned a lot, and I'm sure that our participants had a similar experience. So we'll now start our interactive Q&A, and while I'm talking, you can of course fill in the last poll on, which is probably the most controversial and most concrete and most exciting one. So once you've done the poll, let me invite you all to focus on the chat box and write your thoughts, comments, indeed direct questions to Tobias. If there are too many questions, too many contributions, we'll regroup them. So I saw that both Carl and Ettore had questions, and you will have seen that my colleague Jan, who manages the platform, also posted the results of the polls that might provide food for thought too. Tobias, would you like to engage first with MPS, or does it make sense to first go through Carl's comment, which was related to the new package?
So I'm just wondering, so Carl, as always, is pretty active in this, so he has actually made a couple of comments already. So the amendments are taken into account insofar as they impact on the general policy questions. But of course, the idea of the seminar is not necessarily to really give you all the nitty-gritty in detail here. So
the others.
The idea is actually just to give you an idea of what needs to be done, and I totally agree that there are many amendments that actually go into the right direction. So I should not be misunderstood as criticizing anybody here. I'm just saying, if you are embarking on the concept of bail-in, you have to be aware that implementation is complex, and implementation raises a lot of questions that need to be addressed in terms of how firm you actually are and how predictable you are. And this only to a very limited degree can actually be solved entirely by amending regulation, making level 2 measures actually making it a little bit more clear, but they will remain this discretionary space where some problems actually will remain. And so let me just look a little bit at what pops up from the poll. So of course, there's a lot of talk nowadays where we're actually talking about legal history already, because it is there are some commentators who say, well, you're now breaching the fundamental prescriptions of the BRRD, that there should be private sector involvement, and now you're admitting the Italians to bail out their banks again. And I think this issue is far from clear, but it is also something that shows that if the decision comes ad hoc, the interpretation is far from predictable. And this, I think, is something that feeds into my general idea. Make these rules as firm and predictable as possible ex ante, and then you will face less criticism from whatever side. Of course, it's not the time where you should actually point at others saying, okay, you're breaching it. It's unclear whether that's really the case. So what else have we got?
So maybe the stringency of the new regime, of the TLAC and Amaral regime, could be addressed, because we had two polls on that. One was saying, according to 92% as a result, so 92% of you. No, let's take question 2. I think it was more relevant.
Well,
so TLAC levels are adequate for 66% of people, and then question 4, we have 70% of participants who think that more rigid restrictions on TLAC and MREL instruments should be put in place. So I think there is some contradiction in there.
Yeah, but I think I personally find it pretty hard to predict actually whether TLAC levels are adequate or not. I mean, it sounds like from the experience that we have that this is a good thing. Mm-hmm. But on the other hand, what is adequate in this, right? I mean, it comes at a cost. Of course, you can make your banking system as stable as possible by requiring 100% of equity. But the question here is whether you want to go this way. And in that regard, I think it is unclear what you want to achieve from the policy perspective. I would only say that given the experience that you have, and these levels are actually pretty high, and I'm not saying whether that goes into the right or wrong direction, I'm just saying it's quite interesting to see that through this more or less indirect capital regulation, we're going into a way that in the policy sphere has been discussed, which is more equity. Another aspect that I just want to touch upon, because of course, some comments raise the issue of insolvency laws. How actually do insolvency laws feature in this? And of course, you all know there's this no creditor worse off principle. And that requires us to always look at insolvency proceedings, hypothetical insolvency proceedings, of course. And this is a huge sphere, again, of hard to predict judgment that is involved. Because if you look at what would go on in an insolvency proceeding, in the reorganization of a bank, the problem here, of course, is that you have to make predictions on creditor behavior, how they actually exercise the rights that they might have during insolvency proceedings, and then court decisions in this regard. So it's very, very hard. So I have a radical idea in this regard, which is actually, do we really need no creditor worse off? Because the question here underlying this is, it's an elegant way of solving a property rights issue, arguably, because saying, well, I'm not going to cut you any more than you would be cut in insolvency, clearly takes away the claim that you're violating property rights, because they are defined ex ante by the borders that insolvency law puts to that. But on the other hand, what we're pursuing here, as I made clear initially, is a fundamental goal of society: maintain financial stability in order to make the system work. So it is far from clear that even the guarantee of property rights would prohibit to cut any further than we go in insolvency law. And this would open up a lot of leeway here without actually doing the question, or without doing always this hypothetical, so it would happen in insolvency, which is something that I think you're in a true resolution situation cannot be addressed in any proper way that makes these results that come out of this prediction somehow sustainable in court. But that's just a very, very general remark on this. I'm just saying, yes, there's another way of actually introducing more complexity here, which is looking at shadow insolvencies.
I find this question very interesting about TLAC and the credibility of the new framework, also with regard or in light of what's happening with Monte dei Paschi. MPS is obviously, referred to by several of our participants, so maybe you can engage that.
Well, so the question is, we don't really know what will actually happen at MPS. So the only thing we know is that there is talk about it. So if you simply apply the bail-in tool, what's going to happen is, of course, you're going to cut certain creditors that do not have the loss-bearing capacity that I referred to, because not so much because they're bail-in, so their loss participation has any financial stability implications. But the problem here is the social one. You're cutting, actually, to put it a little bit simplistic, you're cutting the pensioners, and of course this is a problem that actually from a social perspective is problematic. But how should the solution actually look like? Are you, for that purpose, in order to avoid that, actually sparing the bank from resolution by just bailing it out, or are you looking for a way how you can actually reimburse those poor people who are now suffering from maybe what actually also is a question of debate, egregious mis-selling cases? So the question really is whether MREL in this regard could do something, and I would say yes, it can, because we've seen for the banks in TLAC, we have this deduction solution where we simply deduct if, essentially, or simply speaking, if TLAC capital instruments are held by the wrong hands, we deduct this. And we can actually do that if we have some information on the holding of these instruments. We can simply deduct these instruments from the TLAC, from fulfilling the TLAC requirements in banks. So if you are a bank and selling your TLAC instruments to unsuitable private retail investors, this share issue actually is deducted. And if you do that, you take away all the incentives for what could be a mis-selling case, or even if you inform your investors well, from the financial stability perspective, is still a problematic decision because it again raises the political rationale for bailing out banks. And if you undo this, I think that would be just a wise thing. That can be addressed through TLAC MREL regulation.
Okay. Before we go into the individual contributions of the chat, let me ask you a more philosophical question, taking a step back as to the new banking resolution regime. So the starting point being, isn't it that the move from bailout to bail-in was quite fast, and that as the result of this, there are really high expectations around bail-in, which maybe cannot be met in the short term. So there is this contradiction between a framework which is centered around bail-in and maybe the incapacity to enforce it fully right now. So are we in a steady state on bail-in, or are we in a transition for which we try to use the rules which are existing to the most flexibility we can have? Would you agree with that?
I think we are certainly in a transition, and one tiny detail about the MPS case and all the others in Italy is that originally the period until the BRRD should be implemented was much longer, so it would not have to be implemented until 2019. And if you look at the problematic subordinated debt that is now at the core of the discussion, if you look at it a little bit more closely, and we've done that, you will understand that all these instruments would have been redeemed by then. So we wouldn't have the problem. So it is indeed true that for some political reasons that are not entirely unrelated to my home country, so for some political reasons, the implementation of the directive was pushed to be much faster than it originally was. And yes, this leaves us with a lot of transition problems. We don't have any grandfathering because we are actually applying this to the existing balance sheet on day one. So it is well plausible that these are not mis-selling cases, because at the time when the relevant instruments that are now all of a sudden subject to bail-in were sold to the public, no one could actually foresee or at least predict that something like a bail-in tool would be in place. So yes, I agree. We're certainly not in a steady state, but I think also one of the key problems that will occur if we, of course, now make certain policy choices by interpreting certain rules in a pretty lenient fashion and opening up a lot of loopholes or a lot of well, exemptions. It's pretty hard to actually catch that again if we reach the steady state one. So I think it's a little bit of a trade-off at the moment. So someone has actually to suffer in that sense, either the regime as such or some people who, but then there should be solutions to reimburse these people. I think that's the key message here.
Okay, thank you. Maybe I can give you a few seconds to just go through the questions.
Yes,
I think there
are just very many.
We won't be able, and I apologize, but it's a very successful event, and so we have just too many questions. So if you could address 4 or 5 until the end of the seminar, this would be already really great.
Okay, so you're always saying that I think the questions relating to MPS, I don't want to address them because I more or less have already answered. So I think it's really a question of how you interpret that, and it's not so much a question of the TLAC or MREL instruments, really a question of the fundamental bail-in tool, how serious you are and how wide you interpret the exemptions. But the question, of course, regarding to what the FSB is going to do, because currently they are now drawing up these standards only
for GSIBs. So it's only for the systemically important banks, and the question whether it goes also to other significant institutions. Well, insofar I would say as they are also regulated under capital requirements, yes, I guess this is the logic next step. And the big question is how actually the EU is going to implement it, because as I made it clear in the presentation, MREL is something that applies to each and every institution that falls under supervision, essentially, and that means it is something that is also present in non-systemic institutions, and that's a good question how you actually deal with that. And as I would say, if you stick to the approach that you're prescribing minimum capital requirements, minimum bail-inable capital requirements to these institutions, it makes a lot of sense to look at the TLAC standards, because in many respects they are just a little bit more advanced. They are addressing a lot of topics in a, I think, very expedient way that need to be addressed also in the MREL framework, and that are not particularly linked to the fact that the institution is systemically important on a global scale. So that for the future developments, I would say.
I think there was this interesting question by Karel. I still do not understand pari passu treatment of debt holders versus creditor hierarchy. We've got it clear now.
So I'm just trying to make, maybe you can actually rephrase that, because I'm not 100% sure. So because the pari passu treatment of debt holders is something that I think is done away with in MREL and TLAC, because it's relatively clear that, well, the idea here is, of course, in TLAC standards, there is actually even an exemption because in general, I think the issue is addressed with regard to the high quality instruments that are certainly subject to bail-in. The problem is addressed by requiring strict subordination. Then you don't enter automatically into a pari passu problem with other debt holders that are ineligible. And in this regard, of course, the problem here is if you do it like this, and if you're introducing in bank regulation a certain standard, how does that actually interact with insolvency laws, which are national and are probably not necessarily aligned with the treatment that you're giving these financial instruments in banking regulation? And I think here's the problem. Yes, and in general, or in an ideal world, of course, insolvency law would conform with the treatment that you give these things in banking regulation. If that's the case, you don't have truly a problem. But I agree that even in the TLAC standard, there is an exemption from the subordination requirement if the resolution authorities are in a position to treat pari passu ranking creditors differently in insolvency. So even in the TLAC standard, this idea of creditor hierarchy is something coming in again into the regulation, making it even more complex and making it very, very difficult from the investor perspective actually to predict this.
Yeah, at times I wonder how long we can muddle through without harmonizing insolvency law. But I'm not a lawyer, so I won't go into that. So there are a few more questions. We have a bit less than 5 minutes left.
Yes.
I would suggest I mean, go through if there is anyone that you would like to address first. Go ahead.
So from what I see, okay. So maybe here is something that again relates to the MPS case. There are some questions that I think are relevant, which relate to the fact that I have said, well, this was not predictable. Of course, in a sense, it was predictable because these were actually instruments that were subordinate. So it's actually subordinated debt. But what I keep hearing from my colleagues from Italy, and I've been talking actually to some of the executives who have been involved in this, and they're not entirely unbiased, but they have a good understanding what actually is the problem on the balance sheet. And they're saying, well, look, all these shares or all these debt instruments were issued in 2007, 2008, which was a time when in Italy there never has been a subordinated bond actually been defaulting. And if that's true, I don't know. Then of course you can say, well, yes, looking at the hierarchy as such, yes, there is a relatively higher likelihood that this is actually not repaid. But on the other hand, the question is, how realistic is it, judging from past experience? So I would probably uphold my statement here.
Okay.
Now, one interesting questions. Do we have any impact, or do we have any evidence how TLAC and MREL are actually impacting on the asset side, so on the lending business of banks? And I can only say this is something that a lot of colleagues from the finance department here are studying, and around the world are studying. How does actually regulation impact on such figures that are clearly indicating that there's a change? But I would say that the evidence is pretty inconclusive at the moment, and on the other hand, it is relatively clear that from the political intention, and that has to be something that should be clear to everyone, if we have a system where we have excessive risk taking in the lending business or in any whatever they do on the asset side of the balance sheet, in investing in certain aspects, if we think what they are doing is excessive because they have funding that is risk insensitive, the natural consequence here is, well, you get less of these investments on the asset side. So the balance sheet is actually shrinking. And now this is probably the right thing from the financial stability perspective, but it has growth implications, of course. And this is why now all of a sudden our idea or our obsession with financial stability is a little bit qualified by the idea, well, do we really want this? And of course, judging from a financial stability perspective, yes. But again, there is no free lunch, and we have to be aware of that. I think that's my remark to that.
Okay, I think we have time for one single last question.
Okay.
Which I leave to you. Discretion to pick up.
I'm. Okay, so maybe just because that's always good to conclude. So what will be the next steps with regard to MREL? I would say that with regard to MREL, we all know that there will be a tremendous effort of harmonizing the MREL requirements with TLAC, and I would say this is certainly a good thing. And this should be something that should give an opportunity to address some of the issues that are raised that are so far not addressed and are not addressed in TLAC. So make it a comprehensive overhaul of what we know. And in order to get a little bit back to what Pierre was actually hinting at, so make sure that once we reach the steady state, we're actually in good shape with our regulation and then can implement the bail-in tool as it is supposed to work, and have the institutions like MREL or TLAC in place that actually support this. And this is, I think, the road forward, and this is, of course, I think, an optimistic outlook.
Okay. Well, unfortunately, this seminar is drawing now to a close. So let me thank you all for your active participation. I'd like to warmly thank, obviously, Tobias Tröger for his time and dedication also in the preparation. I found this was a fantastic learning moment. It was for me, and I hope you had as much fun as I did in being part of this. So in reality, this is not the end, as we'll have other online seminars over the next month. So please mark your diary for the 1st March 2017, where I'll have the pleasure to talk about the future of COCOs with you and Enrico Perotti from the University of Amsterdam. So stay tuned. Thank you, and see you soon. See you soon, Tobias.
Thank you. Bye-bye.
Thank you. Bye-bye.